Good morning, good afternoon, good evening to everyone across the globe. Welcome to Rock Blue's OLS number 10, Practical Steps to Improving Utility Creditworthiness and Accessing Funding. My name is Barika Poole, and I'm the online lecture series facilitator for Rock Blue. Rock Blue is a global nonprofit working to create a world where everyone in urban areas has access to clean water and basic sanitation. So improving creditworthiness and access to funding sources positively impacts the operational and financial performance of water utilities in developing countries. In this webinar, our lineup of WASH finance experts will explore ways utilities can strengthen their credit profile and gain access to finance. Eyal Chavil is the head of corporate and public sector ratings at Global Credit Ratings. He has extensive experience across the various industries, having conducted ratings for construction, industrial, agricultural, and mining companies across Africa. In the public sector, Eyal has led the credit rating terms for a number of municipal ratings and has also been involved in projects in the water and energy sectors. Eyal continues to work with development agencies in promoting creditworthiness in public sector entities in Africa.
Great, thank you very much. Thank you for inviting me to speak here. I thought today I just wanted to share some of the types of things that GCR as a credit rating agency, or any type of credit rating agency, to be honest, would look for in a utility company and a wash company in this context, but it's more, general utility companies. And how those what are the practical signs that these elements are, these credit positive elements are within that organization. So you'll see as we go through the presentation, it's looking at like a top-down approach of utility companies, and then trying to highlight what are the general signs of creditworthiness and how do those appear within the rating analysis, what we would practically look for. I think we can move ahead. So, I think the first thing to understand is what's unique about utility companies. And the uniqueness is that really utilities are a subset of the broader corporate sector, but they have this unique interaction between the private sector and the public sector, between political requirements, social requirements, and general profitability requirements on the one hand. So understanding that is always critical to basically every element of looking at the creditworthiness of a utility company, because it will define how everything works within that company. So I've really segmented into a few of the major themes that you would look at in a credit rating exercise. I think obviously the first step would always be to look at the legislative environment. So what you'd want to see as a credit rating agency is an efficient structure of the sector, to understand who are the different players in that sector. There's often different levels of water providers, distributors, providers, bulk distributors, to understand who they are, how they fit all the way back up into the ministry and the government levels, to have a look at what type of an industry it is. Is it monopoly, oligopoly? Those type of things will obviously speak a lot to the credit strength and the operating strength of the wash company that's being discussed. Another thing becomes really the obligations of the utility company. So, like I said, utility companies are generally set up. They're not set up with a purely profit motive. They're set up as the main motive is really social, is to deliver a particular service efficiently to the population. Now the fact is, governments want these entities to run at the very least at a break-even level, but if not, at least reasonably efficiently. So again, we will look at that. So So how do we know that these, you know, we want to see that the entity has a strong working relationship with the government. It often happens that, you know, you have a government entity, a government who establishes a like a state-owned company to provide a particular service, and yet the government and the company are talking at different, you know, different levels to each other. And in fact, I often think that sometimes these type of companies are set up almost to shift the blame for non-delivery, if that's the case, that rather than to ensure a strong and efficient environment to deliver these services. And so what would we practically look for to see that the industry is operating efficiency? The first thing I think is transparency. Is that you want to know that if there's a regulator that's appointed by the government to regulate an entity that is basically, or in many cases, a government-owned entity, that there is transparency in how they interact with each other, and particularly in determining the pricing mechanisms. And that those prices, So that is, you know, I suppose the compensation, or put there the compensation for the SOE, that they are able to, within reason, at least recoup their costs, and not only their operating costs, but to the extent possible, their capital costs also. Now, it will come in a later slide. We understand that recouping capital costs may not be possible in many cases where there's a really weak infrastructure to start with. You're going to need an outside source for that funding, but you do want to see that there is an efficient mechanism that can determine prices, that can adjust prices if necessary, and that takes into account of both the utility company's needs and those of the population. I mean, the other side of that coin is to determine what a utility has to do. So their obligations, because like we said, a utility company is generally there to provide a social service, and especially in developing countries, part of that social service it won't be able to collect revenue for. You know, it has to provide a certain amount of free water or free electricity, or roll out infrastructure into areas that would be sub-economic, just because they're poor areas, or because it's so expensive to roll out the infrastructure in there. But those are the obligations, and that's fine. There's no problem from a rating agency perspective in having obligations, but it must have the mechanisms in place to manage those obligations. And generally, I mean, we say in any analysis of government, the more levels of bureaucracy there are, is the less efficient these entities are going to be. So again, going back, we want to see a very transparent, clear legislative environment that allows a company the maximum freedom to operate within its obligations, but with a minimum level of interference from politicians. Okay, so we can move on. Okay, corporate governance in a utility company is quite closely related to the legislative environment. Now, corporate governance really in the public sphere can be problematic, and therefore you need to take a very close look at what is the structure of the utility. To identify what are the potential conflicts of interest, and how are these being managed. So again, like we said, is that there are certainly the politicians want the utility to roll out and provide services to the maximum number of population that's possible, or even impossible, because then it makes them look good. The utility is constrained by its operating costs and its funding sources, so it can't just do that. It needs to operate within a private sector type of profitability framework. And that causes a lot of political interest. I mean, further than that, there's a lot of opportunities within utilities because the budgets tend to be large, and because the services they require and tender for tend to be large. There's a lot of opportunities for malfeasance and rent seeking in utilities, and clearly then within the utility itself, the decision making is no longer on how best to provide the services it's obligated to, but often becomes about how best the managers and their friends can be rewarded. So we'll always look at the rate and quite closely at the corporate governance steps that are taken and put in place to manage this. So as a first step, I think you'd always want to see that the board is weighted towards appropriately qualified and independent professionals. A board that is purely political or political appointments, has much more scope for, to weigh decisions towards political or rent-seeking interests as opposed to commercial interests. We would always look to see that there are policies and procedures in place to manage how tendering is done, how supply chains are managed, what's becoming increasingly important is policies to deal with politically exposed people, how you deal with that in the company or with families and friends and those type of things. So you definitely need to have a strong board and strong policies in place. But policies, I suppose, themselves are no panacea for all the challenges a utility can face within the corporate governance world, and therefore perhaps the clearest indication of a utility's operating independence and the seriousness of which it takes corporate governance issues is whether when issues do arise, and they almost always will arise in small or large things, are these investigated vigorously and punished where necessary? To the extent you can have the greatest policies in place, but if nobody's investigating, everybody's turning a blind eye, that's not going to help avoid those problems. And these are, in most cases, where the utility is not operating efficiently, it comes down to the management and the decisions they're making, the reasons why those decisions are being made. And it's generally not because they're not being made in the interest of the entity or the entity's purpose. So we want to see that, if there's a good track record of investigating and punishing corrupt and wasteful expenditure, that is probably the most important sign that corporate governance is being taken seriously. And then, on that also, the operational independence. Can this entity take decisions which may not be politically popular, but are commercially necessary? So say laying off staff, can an entity do that if it finds that it's got a bloated staff component? That becomes important as we'll see later, the funding side in managing its operations. Okay, we can move on. Okay, the other factors that we look for is to understand what is the key mandate of the SOE. Like we've already touched on, that SOE is there to perform a social function. And to the extent that it performs that function well, we believe that it will be more creditworthy because it will get support from a wide range of institutions. And so to determine this, you really need to see what type of a utility it is. That's generally quite obvious, but then to see what are, again, its obligations, looking back into the legislative environment, what are its KPIs in its own strategy documents, And is it fulfilling those KPIs and making a really a meaning contribution to the social fabric of a society within which it operates? You know, I look at a rating agency, and at the financials, it's hard to just say, you know, this particular indicator should be X and this one should be Y, because each country, especially in developing markets, is very different, and different type of entities are different. So we're not looking for a particular operating margin or efficiency margin, but what you want to do see is that there is progress constantly being made. So if the KPI is to roll out sewerage infrastructure to new neighborhoods, and you want to see it, that at least it is moving forward. It doesn't have to be hundreds of kilometers of new pipes every year, but there needs to be continuous progress within the against the strategic targets, and just at least moving forward in those things. So we always look at KPIs relative within the entity itself. How is it doing compared to last year and the year before, and compared to the targets it sets itself out? I mean, you will also always want to compare what are international best practices with regard to a particular entity, or what are best practices of entities in similarly developed or underdeveloped countries. That may be that'll be generally a better comparative. How are these entities in neighboring countries or countries with similar GDPs and developed stage of development performing and that's where, you know, having a broad view of utilities across Africa does tend to be beneficial. Okay, in terms of financial stability being the other key factor. I mean, it's very nice if you are performing your functions, but you do need to be sustainable, and that is part of the reason for setting up a utility or a state-owned entity, is that it's believed that these entities should be more sustainable because they operate more on a commercial basis than if it was just a government department performing the same functions. So that is key. Now, the problem most utilities face is that they're not necessarily in control of the revenue line, because the revenues are determined by the population, and yes, they may be rolling it out to a greater percentage of the population, but it is limited. Their ability to grow usage is largely limited by that infrastructure that they have and the ability to roll it out quickly and that. And the second one is that generally tariffs or pricing is determined somewhat externally. So I mean, utility will generally, like I said in the previous slide, you want to see that they've got input into the pricing and tariff determinations, but ultimately it's normally a regulator or a government department that determines the tariffs. So if you can't really grow your revenue meaningfully on a year-to-year basis and your tariffs are externally determined, really your operating performance comes down to how efficient you are and how you manage the cost side. So how much of your cost base is going on things that are consumables type of thing? How much is going just on pure staff costs? I mean, that's generally the biggest single chunk of operating costs that a utility will face. And then to the extent that it's being spent on staff and consumable type costs, there's less probably going to be available for capital development. So we would look at various ratios to determine how efficiently an entity is operating. So staff cost ratio, you know, a maintenance cost ratio. Maintenance is obviously critical because, you know, a utility can often hide expenditure by not doing maintenance, yet that maintenance actually does have to be done. It can be maybe put off for a year or maybe even 2 years, but if it's not being adequately carried out, those expenses are going to materialize in a significant way at some stage. So you need to look for, I suppose, the hidden costs that are not being incurred also when we look at the expense ratio. You know, another critical aspect of that, it's actually not on the slide actually, I see, is financial stability is in collections. Can you, you know, it's all very nice billing people, but are you able to collect that money that you bill? And that's obviously a major challenge in a lot of developing markets, billing and collecting that. And most utilities in these markets run up massive unpaid debtors books, which at some stage perhaps won't even can't be collected on. But you want to see that a utility is, at least on its current debtors book, managing to improve collections, to keep collections at a high rate, and therefore ensure that it is financially sustainable, because, well, you need that cash flow is what's critical. You know, you talk about cash flow, again, like we talk about hidden costs. You know, a utility can often not pay suppliers, and cash looks better than it should be, but it's only because their creditors are going up so significantly. So, you know, a creditors ratio will also become an important thing to look at, is what's driving that. Debtors and creditors, therefore, are critical to determining financial stability of such an entity. Okay, I think we can go on to. Okay, then what I suppose from a rating agency, ultimately it comes down to funding. So what are the important considerations here when it comes to funding? So really, I mean, one of the major reasons that a utility is set up as a private company is to expand its access to capital and thereby reduce reliance on government sources of funding, with things like taxes and levies and license fees for its operations. So, but in order to expand its capital, you want, you know, then private sector investors will want to see that it is operating efficiently, to say the least. The other benefit that, you know, utilities have is that generally they have long-term projects, and therefore it's most appropriate to fund these with long-term maturities, you know, and further, I mean, the projected income generally tends to be stable in a utility, so it lends itself to this long-term type of funding. But so how do you determine the strength of a utility company? So first of all, one of the unique features, like sort of just touched on, is that there is a fairly stable income base that can be projected more accurately, let me say, than for a general corporate company in a competitive environment where it's much more subject to shock. You know, if you're providing water, everybody needs water. It's generally a monopoly or oligopoly, so and not open to other competitors, so you're not faced with those risks. So your cash flow forecasting can be fairly stable. Accordingly, utilities can have higher debt levels. We accept that as a rating agency, that because of that stability, a higher gearing metric then would be allowed, or let's say advisable in a corporate entity, is not as concerning in a state-owned entity. Nevertheless, I mean, obviously too high debt is the downfall of almost every company that collapses, and utilities are no exception to that. So you need to see that even though debt can be higher than average companies, that it needs to be sustainable. And you have to make sure that, particularly on an earnings-based level, that there's enough earnings and enough cash flows, in particular, to meet all those debt obligations that a company has, after meeting all its other just general operating costs. So we'll obviously often look at a cash flow type ratio, cash flow to interest or to debt service cost ratios, to make sure that the company is sustainable. And you want to see that it's not just covering it by 1 times, but perhaps with headroom, so 2 to 3 times, coverage would be great. Higher is obviously ideal, but that may not serve the purpose of the company in terms of its social mandate, because it does need to invest in its infrastructure. So it's not there to hoard cash or to make super profits. Those need to be reinvested. We also look, obviously, to see what access to capital a utility may have. So you only see that the wider the access, obviously, the better. You only see that it can access both private funds, development funds, government funds, even perhaps capital market funds. That's ideal. Now, generally within those categories, you also want to see that it can, in developing countries, access concessionary funding would obviously be positive, because it would generally reduce the debt service cost from the interest perspective. And development agencies tend to be much more forgiving if times get tough and perhaps loans need to be restructured or that type of thing. So having access to those concessionary fundings, particularly in developing markets, is quite important. And then what also becomes critical is looking at the debt maturity profile. Is that, like I said, utilities are well positioned to take longer term funding, so 10 to 20 years, which may not even be available in most markets. But even if it's not, is that those maturities on loans are well spaced out, and that there are appropriate mechanisms in place to make sure that they can be met. So that may be a type of a sinking fund, or another type of security structure which traps certain portion of cash ahead of any interest payments. Those obviously would all support a strong funding profile when looking at it. So what you really want to see is that gearing is not excessive. It can be high, but it can't be excessive, and it must be manageable in respect. Access to funding should be as wide as possible. And the truth is, again, it's access to funding. Private sector funders have different criteria to development funders, and just the exercise of going through these, complying with all these different criteria to get private sector funding or to get development funding will generally ensure that will be a good indication that a utility is on the right track, because it does have this that sorts out the commercial and the social aspects and everything. So those are the type of things in funding. And finally, the last thing that a utility will have, and this is somewhat external to it, is that government support. And perhaps it comes back to the legislative environment. But ultimately, like I said, a utility company is there to provide a particular social service. And to the extent that that's a critical social service and it is being performed efficiently, we would expect a government to be supportive of that company. Now, that support can come in two forms. The one is just general business case support. You know, if this company is doing, or this utility is doing what it should be doing efficiently, then it's less likely that the government is going to adversely change legislation or just change legislation. And it's more likely that this company will be consulted on any changes to the industry or how to advance the industry. So it becomes a much more important feature of the economic and governance fabric of a country where the entity and the government are very much in sync, and the more efficient it is, the more likely that these are going to be in sync. And therefore, this will just generally support a very constructive operating environment for the company, which in turn would likely translate into a good operating performance. The other side of government support that you look through is there any track record of financial support? So, I mean, governments in most cases have set up these companies, so there obviously was some sort of financial support at some point, but the fact that they've been privatized to some extent or commercialized means that the government does not want to continue funding the companies. Nevertheless, you know, a government can't just let a water utility collapse if it is the only provider of water in a country or in a city or region. So there is some certainly implicit support in that government support. There's some implicit government support. Now in this, and it's different in different cases, but you got to look at it and think of, well, is this long-term support or short-term support? So long-term capital support is important, but I mean, it can be pushed off. So if the government's treasury is having problems, or you know, tax collections were not as good during this year, and there's a shortage of cash, long-term support can and tends to be pushed off in capital projects. It may be necessary, and it certainly wouldn't be a good sign if it's pushed off all the time, that type of capital support, but it can be, there's more scope for it to be pushed off over the short to medium term. And that, again, that's okay. Let's still say that the government does support a company, and it does, when it has cash available, it provides the capital support that's necessary generally for infrastructure development, but that can be pushed off. Short-term support may be more critical, because that's if this utility runs into problems today, cash flow problems, and that does tend to happen. There may be a bond issuance that needs to be redeemed, and there's suddenly no cash, or collections have fallen off a cliff, and short-term, that's the type of support that can't be delayed, because that would perhaps cause a default to debtors or to funders. So you want to see the government has in the past provided short-term support to the extent that it is necessary. And finally, I mean, the guarantee, I mean, from a rating agency perspective, a guarantee would be the strongest form of support, because that is legal support. So we would look to guarantees. I mean, at such a point, you could rate a utility up to the level of the government itself. You know, until there's a guarantee, you generally say, well, a utility may have very strong government support, but it's still somewhat of a subordinated obligation of the national government. The national government will first have to meet its debt service obligation, and then it can worry about its utility. So it's important, but it's somewhat subordinate. Where there's a guarantee, obviously that subordination falls away, and it would be ranked with all other government debt. So So it could be equalized. So it's a type of thing. So we would look at guarantees, and that may not talk to the issuer quality itself of the utility, but that may actually just be a factor of an issuance. So an A-rated utility could issue paper that is rated at AAA because of the guarantee that backs that specific paper, but not the entity itself. So I mean, hopefully I've just given you a bit of an overview of the type of things that a rating agency looks for, the reasons why we look for it, and how practically they emerge within the analysis. Thank you.
Thank you, y'all. We have a few questions. So Terry Thomas says, when you assess credit worthiness, is the size of utility a major element, meaning a small town with 5,000 connections against a larger town with 50,000 connections? Does the approach remain the same?
Yeah, so I think the approach remains the same, but clearly larger entities a smaller entity probably won't reach the same rating level as a larger entity, all things equal, assuming their performance and their balance sheet and everything else is equal, it won't reach that. And that's because, again, in terms of its importance to the country, and in terms of its probably importance in the greater ecosystem of water delivery, it's probably not as important. And by having lots of small distributors, it probably implies that there's somebody else who could take over that role if necessary. So, in the GCR criteria, I think on competitive, the entity profile, or the competitive profile, and there we would look at these type of factors, and generally a bigger entity, all things equal, would get a higher score, which would lead to a higher rating. So yes, I mean, an entity that supplies a major metropolitan area or that supplies the whole country will have a higher rating than in an environment where each little town has its own, say, just water distribution entity. But it's hard to say exactly what the difference in ratings would be. Probably, yeah, I don't know, probably 3 notches. But I mean, it's hard to say that.
Okay, all right, thank you. The next question is, could you speak to, one, the strengths and weaknesses of existing methodologies used for assessing corporate governance aspects, especially corruption, fraud risks, as part of creditworthiness ratings? And 2, how governance indicators are weighted relevant to financial ratios in determining creditworthiness in water utilities?
Okay, so I mean, I can't really speak to, other criteria. It's a bit generalized, what other criteria. What I can explain is go a little bit into depth is how GCR looks at management and governance. And that hopefully would, we think that this is the way, to look at it. Because it is quite a subjective thing, management and governance. You can never say one factor is objectively good in terms of governance and one is objectively bad. So what we really do is have a set of criteria, and we look at those criteria. And if there are a number of red flags that come up in our rating, then we will either penalize the rating depending on how severe it is, or not, perhaps choose not to rate something if it's really severe, that there's a lot of red flags. So the type of things we'd look at is, the complexity or opaqueness of the operating structure. Truthfully, that's not necessarily a problem for most utilities. It's much more a corporate problem. We've got extremely complex companies operating with holding companies in different countries and jurisdictions, where it becomes impossible to see what's going on. That would be a red flag. That's not to say that just because you have that you need to be penalized on corporate governance. No, but that would be a flag that is raised within our discussion. Another one would be shareholding. Again, not in a utility context, but in a utility context, there would obviously be the board structure would be more important. The political interference or lack thereof would be the major considerations. Where we say now most utilities probably have a board that's appointed by the political entity. Now, again, that in itself is not, it's not ideal, but if we see they're appointing, like I said, a board of suitably qualified independent experts in various fields related to this, that would not be a serious flag. You know, having the necessary policies and procedures in place. You know, sometimes you'll operate in a country where it's much less developed, so you won't have as many policies and procedures. You know, it may be a slight negative on its own. We probably wouldn't penalize it, but if it does come up, then we see with a lot of political interference, and there's not enough policy, we don't think the policies are sufficient, then those two together would probably say we would penalize it in our rating because of corporate governance concerns. So I mean, I'm happy to go more detail, I mean, into the other things we look at, but you know, I think that just gives you a good idea of how we look at it.
Okay, great. Thank you. So we just have a couple more questions. One says, just to clarify in your last slide, are you considering guarantees as the same level of autonomy, independence of the utility to the government?
I'm not 100% sure the question, but I think the guarantee, like I actually said, is more important in terms of an issue, like a bond issuance that has a specific guarantee. That's more likely to be the case, and that could then have the same rating as the national government or the whatever entity is issuing that guarantee, because it's a look at. Now you'd also have to look at the terms of that guarantee. What are the payout terms? At what point does the guarantee kick in, and how quickly does it settle the creditors in the case there was a default? You know, those type of things. If it's not quick and it's not easy for creditors to collect on that guarantee, then we probably would not say it ranks the same as, it's rated the same as the guarantor. I'll say just general financial guarantees, like I said, we would see it more as a subordinate type of obligation of the national government, and therefore the entity could get some uplift for it, depending on the terms, but will not get complete uplift to the sovereign level. Because and I think our thinking is generally that, you know, a government may have to ensure that a water entity operates, but it doesn't have to operate at a AAA level. It can operate at, say, a BBB level, the basic level that it provides services and just gets by on a day-to-day basis. So it does not have to be uplifted to that government level.
Okay, great. We have a couple more questions, but I'm going to move on in the interest of time, and you can answer them later, and they'll be posted to the website.
Okay, well, that's perfect.
Okay, thank you so much, Yael. Okay, our next presenter is Anne Munua. Anne is a project leader at Open Capital Advisors, a management consulting firm that has completed more than 800 engagements to date across 25 sub-Saharan African countries, and has a broad wash experience working with water utilities across public and private sectors in Africa and Southeast Asia. She has advised water utilities in Kenya through USAID's Water Sanitation and Hygiene Finance Program to assess their creditworthiness, identify areas to strengthen their creditworthiness, and prepare bankable proposals to access financing. I'll turn it over to you, Anne.
Yeah, we know there's a large funding gap to meet this. And at the heart of this, we know that utilities, both private and public water utilities, constitute a large part towards universal access to water and sanitation. And to close this financing gap, there's an opportunity to have a look at financing utilities in innovative ways. So layering on to what Eyal was talking about. So it could be blended financing facilities. This could include guarantees, for example, whether it's from the government, whether it's from development partners to commercial investors, to provide that level of comfort that for utilities that are considered risky, that in case of default, then they will be able to cover this cost. It could be based on, for example, output-based aid. If a utility is able to meet pre-agreed milestones, might be number of new water connections, number of new sewer connections, then that aid comes in to be able to offset the commercial financing that the utility was able to bring in. And part of this is also public-private partnerships. Normally, this is for large projects. It might be large water projects or large sewer projects that typically enter into PPPs. And the other avenue as well could be local debt financing as well. However, for these investors to have that level of comfort, to be able to provide or put in capital in water utilities, they do require an understanding of the risk profile of the utilities. And this could include, for example, formal credit scores. So to Eyal's point on what she was talking about some credit agencies, some global agencies that such as Moody's or S&P. And then this typically includes, for example, if they're not looking at even these global credit agencies, it's typically a long due diligence process. Essentially, investors really want to understand what's the business model, is it scalable, what risks are involved therein, do you have a large market opportunity to be able to tap into, what do your financials look like, what are your historical financials, are you able to sort of cover your running costs, and going forward, what are your projections, are you expecting to grow, are there sort of any risks, what are some of the assumptions that are behind those financials, and very important is who's the team that's driving this water utility, what sort of like that technical expertise, strategic expertise, and what's the vision for the company going forward, what sort of growth plans do they have in place. So there is an opportunity to leverage blended finance, and to be able to access this, the investors do need some form of being able to understand the risk profile. So moving on to the next slide. But here what we see typically is that to prove that creditworthiness, utilities typically struggle with this. And some of the reasons might be some limited knowledge on some of the key components that investors are using to assess creditworthiness. It might be sort of a lack of a credit history, for example, if you've mostly been relying on government funds or donor funding, and you don't have that strong credit history or what commercial investors are looking at, then that sort of is a hindrance to you knowing what components you need to look at so that you can be able to prove creditworthiness. However, we see that across sub-Saharan Africa, some strides have been made by WASH stakeholders just to demonstrate this creditworthiness. And if we look at this, looking at some of these formal credit scores away from the credit agencies is, for example, in Kenya, we have the regulator, which is the Water Services Regulatory Board, partnered with the World Bank to create an annual creditworthiness index. So essentially for water utilities that might not have access to some of these global credit ratings or other credit ratings, there have been strides made by some local players in partnerships with development programs just to create annual creditworthiness indexes that they could have a look at to be able to assess their creditworthiness. Moving on to the next slide. And here what we'll do is really look in depth at this creditworthiness index that we used under the WashFin program. We took a bit some ratios from the WashReb, added some qualitative ratios, and created a creditworthiness index that water utilities could have a look at as a first screen, just to be able to access that, to assess their creditworthiness when they're looking for funding. And to note here is that you can use this framework not only for external purposes to look for funding, but also as an internal resource. So to be able to assess what do you need to do to be able to strengthen your creditworthiness, so that even when it reaches that point where you need to seek for external funding, you've already sort of looked at this internally and have put in place the necessary measures. So here, what we did is looked at the WashReb Creditworthiness Index. Here they do have tons of financial and operational data and ratios and sort of measures that they look at, and what they do annually is to prepare a report ranking water service providers, and specifically public water service providers, using this index. So this is helpful just as a first screen for potential investors to have a look at that risk profile of utilities based on what WashReb publishes annually. So as I mentioned in the previous slide, what we did is from the dozens of financial ratios that they have in place, we looked at a few and selected a few that really help investors to be able to get that quick snapshot of companies. And then we also incorporated some qualitative components. So investors will be very keen at looking at the management capacity, seeing what the relationship is with relevant stakeholders. So for example, the national government, the county government, as Yael was talking about, like that really influence the operation of this utility in its different places that it operates, or it's in its respective jurisdictions. So moving on to the next slide. So what we did in terms of creating this framework is really focus on three main elements. And the first one is just an overview, a snapshot of the company, really look at the company currently, like how efficiently are you operating, what's the market opportunity, and just be able to pick like some of these key factors that just enable you to be able to assess this. So for example, what's the collection efficiency, what sort of the population that you have in your jurisdiction, and how much have you covered so far and how much is left. And then from the WashReb index ratios, we just picked a couple of ratios here. So ranging from profitability, which helps you to understand sort of the cash flows, or the cash flows that are left after the company covers its cost. We looked at debt, for any existing debt that's currently there, how are you able to efficiently pay it back? What's the sort of depth or bandwidth that you have to be able to take on additional debt? And then obviously liquidity. The P&L statement might be showing that you have some profit, but do you actually have liquidity therein? Are you able to sort of recover the revenue from the sales that you've been able to meet? How liquid are you to be able to cover your ongoing costs? And then finally here in the qualitative and other considerations, really looking at that management capability, looking at the appetite for financing. You might be technically sound, you might be looking at some of that strategic oversight, or really thinking strategically about the company in the next 5 years, 10 years, but you really don't have appetite for financing. Maybe you think, for example, you haven't had that credit history in terms of reaching out to commercial investors, so you might be risk averse to that and looking at sort of softer capital, looking at your growth plans. What growth plans do you have in place? Have you documented them in some form, even if it's very high level? How are you facing those those growth plans? And then finally, to the point of credit history, what's been the past borrowing experience, and what potential loans do you have in the pipeline? So we'll unpack each of these segments a lot more. So here, overview, again, to my point I made in the earlier slide, just looking at the market opportunity and operations efficiency. So here, when looking at the population that's in your jurisdiction and percentage coverage, it just helps us to get a sense of how much have you been able to cover. So if you've covered, for example, 98% of the population in your jurisdiction, is there space to sort of increase your jurisdiction, or is that the only sort of population that you have access to, which shows that you have a limited opportunity to sort of expand your market, whether it's like increasing your water connections or increasing your sewer connections. So here it's really important just to map out what the market opportunity is. If your market opportunity is constrained, is there an opportunity to increase your efficiency? So in as much as the market might be constrained, can you be able to increase your efficiency and be able to increase your revenues or even reduce your costs? And then looking at non-revenue water and collections efficiency, again to the point of efficiency, is how are you currently delivering the service? How large is your non-revenue water? What are some of the drivers that are causing this? Is there opportunity for you to be able to start reducing that even before you get capital? Part of it might be a large infrastructure project in terms of like maybe replacing your pipes and whatnot, which obviously needs external financing, but are there strides that you can be able to start doing now to be able to improve this even before getting external financing? And then also, for the sales that you're sort of recording in your profit and loss statement, how efficiently are you able to collect revenue from this customer segments? You might record a high sales value, but in terms of being able to collect from your customer segments, you're probably able to maybe collect maybe 60% or 40%. What are the drivers for this? How do you make sure that you're already starting to collect revenue? Do you need to put in like some strict cutoff measures, sort of like measures for reconnection and whatnot, just to incentivize your customers? And if there's some who have sort of like large debts, how do you sort of make sure that you're putting in maybe arrangements in place to be able to pay that in piecemeal? Moving on to the next slide. So here, picking some of those ratios, again, there are countless or dozens of ratios that you could look at here. And I know Eyal touched on a couple of these, but we picked some specific ones just to be able to act as that first screen when you're looking for funding. So for profitability, looking at the operating margins, what's the ability of the company to cover their cost via internally generated funds? If there's an opportunity to increase sort of like the tariff that you're charging, is it a tariff that's been there for the last maybe 10 years or so, and you're just not able to meet your costs? Is there an opportunity for you to look at what your costs are and make sure that the tariff reflects that, just so that you're able to cover your O&M going forward? And in the instance where you have an opportunity to also building, for example, some of those like growth plans that you have in place, are you able to also factor in the tariff, just so that you're able to not only cover your running costs, but also potential costs that come from financing for growth plans? Or even setting aside a certain portion of money per month to be able to cover some of those expansion plans. And then moving on to debt, what's the ability of the company to service current debt? What's the debt coverage ratio? You'll find that investors typically have sort of like a recommended level. Typically, it could be 1.3, for example. Where are you within the recommended level? Is it above or below? And what do you need to do in place to be able to cover that? And then also for further debt, what's like your total assets to equity ratio, just to be able to assess that. And then for moving on to liquidity, for the data days, and I know this is usually sort of a big point or pinpoint, especially for public water utilities. It might be maybe some legacy debt, legacy sort of debtor days that came in. It might be some customers, for example, who've lagged behind. Is there an opportunity to sort of have arrangements in place where they can start paying it in piecemeal? If it's a really large amount, they might not be able to cover it all at once. But is there an opportunity to be able to have arrangements in place so that you can be able to pay that over time? And then in terms of liquidity ratio, for example, are you paying your suppliers in time? I think AL had mentioned that, for example, you might not be paying your suppliers, for example, and that sort of gives a false sense of cash flow. But when you look at the liquidity ratio, for example, you're able to see what that translates to, what sort of the cash coming in and the cash going out, and how can you be able to put in measures in place just to increase your liquidity. And then moving on to sort of the last segment here, some of these other considerations. So what's the management capability? Do you have a strong, experienced management team? What's like the technical expertise for the different sort of C-suite roles that they have in place? Are there any sort of like political interference that's then overruling what the management team, I guess, growth plans or decisions have in place? Is the management interested in taking on financing, or are they only interested in sort of like growing organically? What implications does that have on the company itself? And then for the growth plans, what growth plans that the company have? They might have six sort of like initiatives that they want to get into. Are those even written at a high level somewhere? Maybe some are more advanced where you have like the BQs in place so that it's really detailed in terms of what financing you need. How do you expect to phase them out? What makes sense? Which growth plans make sense to start before proceeding with another one? Does it make sense, for example, to invest in a reduction of NRW projects before expanding to other regions? And then what's the capital need for each, and making sure that you're stating that. Really helpful to sort of lay those out so that even when you're looking for external financing, you know, if I'm looking for this certain amount of money, which ones do I prioritize vis-a-vis others, or which ones do I get from which investors compared to others? And then finally, what's the credit history in terms of what's the borrowing experience that you've had so far? Which are the sources that you've borrowed from, whether it's government, whether it's from donors, whether it's from commercial investors? It's really helpful to just start building that credit history to show that you've been able to successfully borrow and repay in the successfully borrow and repay in the past. And then what are some of those potential loans that you have in the pipeline, so that as you're looking for additional financing, back to the point of maybe you have like 3 to 5 growth plans, if you already have maybe loans in the pipeline for around 2 of those growth plans, if you take on additional financing, what are the implications, for example, on your debt service coverage ratio? Are your books able to support those repayments? So all in all, how do we take this forward? How do we take this forward? And here, this is a high-level snapshot of how you could think about seeking external financing. So as I had mentioned previously, assessing creditworthiness is really not only an external resource, but also an internal resource. So here, just looking at external financing specifically, the first step really before you even go out and start looking for financing is, what are your growth plans? What's the capital need for this? What's your repayment ability to this? This also helps you to really assess which investors or financials will be suitable for you. So if, for example, your profit margins are really low, then you really need some patient capital or some softer capital, which could be either blended or perhaps maybe you're looking for government funds or donor funds, but it's an opportunity also to get some blended financing, whether it's a mix of like commercial and donor commercial plus government stroke donor financing. Let's say, for example, you assess internally and you're able to see, okay, I can be able to get commercial financing. Then the next step is to figure out who would be a suitable financier. So maybe it's the local bank that you bank with. You approach them and present your growth plans and the capital that you're seeking. They'll typically ask you a couple of initial questions just to get a sense of to get a better sense of your business, to get a better sense of what the growth plans are. And this is an also opportunity for you to also conduct some initial screen for them as well, find out like what the terms would be, what's the tenor, what's the interest rate, and what's not. And not only to stop there, but also have a look at maybe some other 2 to 3 banks and just get what the interest rates are, what the tenors are, to get a sense of who would give you the best offer. And in these conversations, they'll also tell you what the requirements are, what the process is. Maybe you go straight to the head office, or maybe you start with sort of like the branch that's within your area that would be able to come to your site, conduct that first screen of due diligence really easily. And once you get the requirements, then you get a better sense of the investor outreach materials that you require. Probably it's like a business plan with some key sections that you need to put together, the past financials for the last 3 years and whatnot. So just making sure you're putting that together, submitting them to the specific investor, and thereafter they'll start due diligence on your company. So look at the materials, assess whether you're a good fit, and then once they do that, might even come for a site visit and whatnot. And the due diligence process differs from whichever type of financier. For local banks, if everything is ready, if all the materials are ready, the process might be a bit faster compared to, for example, an impact investor who will really want to do a detailed due diligence just to make sure that they understand the company better. So this is a snapshot of some practical steps just in terms of getting external financing. And I think for creditworthiness going forward, for example, you could have a look at the framework that we put together, use that for your company just to act as that first screen for creditworthiness as an internal resource, and also for external financing, just to get a sense of what investors would be looking for. The other thing would also be to look at your specific country, for example, see if there's sort of any creditworthiness indexes that have been put together by the regulator, might be the regulator solely on their own, or plus another partner as well, and look at some of those recommended levels and use that going forward. And for investors as well, I think using those sort of like creditworthiness indexes that have been put together, for example, by the regulators, may also be helpful as that first screen. So with that, I think I'll pause for questions.
Thank you, Anne. Just one question. You were talking about, kind of the process and the length of time. Can you just give us an example of, or an average of the length of time it would take to do this whole process?
Yeah, so it differs by financier. So for impact investors, it might vary anywhere from like 6 months to 1.5 years. From that first point of contact, which is like that first conversation where they get to know about your company. For banks, this tends to be typically shorter. It might take a month, it might take 2 months, depending on the process for the particular local bank.
Okay, great, thank you. We do have 2 questions. Looking at the formula, what is the formula for O&M coverage ratio and the formula for the liquidity ratio?
Yeah. So for the O&M coverage ratio, what we typically take is all the O&M costs divide by the revenues to get what that O&M coverage ratio is. And then for the liquidity ratio, what we take is the current assets divided by the current liabilities. And for liquidity ratio, it's different. It takes like a broad range of spectrum, but that's just like an example that I've given there.
Okay, great. And just a question also, how has utilities have been stressed during this pandemic, and how has the pandemic really affected these ratings in any way? I imagine in terms of profitability, debt, and liquidity, that those those have been affected for these utilities. And when
Yeah.
talking about these ratings, have there been any leniency or any adjustments to these ratios when you're looking at these utilities?
Yeah, for sure. The COVID pandemic is definitely one that has affected water utilities all around. Looking at, for example, the end consumer, some have had like their jobs laid off and whatnot. So there's been limited ability for them to pay back the water utilities, which has sort of had a snowball effect. And I think that's affected their profitability ratios and whatnot. I think sort of like the recommended levels have sort of still remained the same, but what has been helpful for most financiers is that there's been arrangements where there's been some restructuring. So if you are, for example, expected to pay a certain amount of money per month, you're able to go to approach your local bank, be able to negotiate and restructure those depending on how your cash flows are coming in. So definitely some positive all around in sort of like the ecosystem, looking at what the effects have been and figuring out structures just to make sure that the water utilities are able to restructure and keep afloat and still keep providing the services.
Okay, thank you so much, Anne. Okay, we're going to move on to our last presenter, who is Andre Kruger. Andre is the CEO and founder of PPP Training Online, an internationally accredited firm that has trained over 500 infrastructure practitioners from across Africa and developed specialized PPP courses across various sectors. For more than 30 years, he worked in banking at ABSA Group Limited and Barclays Africa. Andre specializes in infrastructure finance and public-private partnerships and is a passionate proponent of increased private sector participation in the delivery of infrastructure and enhancing service delivery. Thank you. Andre, I'll turn it over to you.
Thank you, Barika. I appreciate this. Does sound good? Can you hear me?
Yes, we can hear you.
Thank you. Yeah, colleagues, thank you very much for the opportunity. I am going to tell you a story today. So you have heard quite a bit of technical inputs of how credit agencies monitor and rate government institutions, specifically municipalities, and also provided quite an insightful piece of work that USAID WASHFIN concluded. So I'm an ex-banker. I worked for the last 20 years of my career working with public sector entities. So in the Barclays Africa Group, I also for a 3-year period headed up the Public Sector Credit Office. So we granted loans to utilities and government departments who can borrow, etc., across the African continent. And so one thing that just to preempt the story that we found is that many times you will find a government entity knocking on your door for long-term finance, offering you dated financial statements, meaning they are not up to date, they are a few years behind, they are not properly audited, and you as a commercial bank can actually not help them. So as you would know by now, the most important role player in any bank debt is actually the jockey, the CEO of the company, the city manager, of the municipality, or the mayor, whatever the title of that person is. If that person is a political appointee, commercial banks typically can't help them. Commercial banks, and I want you to also take the position during this discussion that you are all part of a commercial bank, and you've got a municipality knocking on your door for long-term finance, a utility, a water utility knocking on your door for long-term finance. So please consider it from that perspective. And remember, your investors in your bank represent mostly private sector people that invested their money into this bank. And so there's, in South Africa, we've got something like reckless lending. So if a bank would grant long-term loans to a municipality and the municipality goes bankrupt and they can't repay the bank, it's viewed as reckless lending, and they don't need to repay the banks because the bank did not evaluate the position very well. So let's move on. We are going to talk about long-term integrated planning. And remember, you are bankers, and we are going to look about what's happening in the bigger market out there around municipal services. It may not happen in your municipality that you are working with, where you are staying, or in your country, but it's happening across the world. Disintermediation, the growth of technology. So initially, I was a career banker. Initially, when this started to happen in banking, all of us said, nonsense, this won't happen. Nobody, this is too difficult a sector, and others won't participate in this market. Well, by now we know that retail stores offer banking services and many others, telecommunication companies. The same is happening in the municipal space, in the water space. You would know that the private sector worldwide is already selling more water than governments, even although governments are saying we are the custodians of water and only we can sell water. So whilst government maintain that position, and I'm not criticizing government for the position, I'm just speaking to the fact that governments are being disintermediated. And I've listed some other sectors where it is happening, where the private sector is generating their own electricity through solar and using less and less municipal electricity. And between water and electricity, those are the big income generators in municipalities. So what happens tomorrow if most of your market, over the weekend, I've been to my sister that lives like 200 kilometers outside Johannesburg, and they make use of bottled water. The municipality's water is just not good for consumption. You can scarcely bath in the water. And so the private sector see these opportunities because people are willing to pay for water. So I'm going to move on. I've just listed some other sectors there. And if you dive deep enough, you will see that the private sector more and more are delivering services previously delivered by municipalities. Can do the next slide, please. So what is the solution? What should municipalities or could municipalities do to make sure that they stay relevant? The fact that they are politically orientated, created through policies, etc., won't save them. And if I can refer you to the telecoms industry in this space, typically governments deliver telecoms to the world, to their citizens. And today, they've been completely replaced. And I can hear that some of you are feeling uncomfortable about this, but I'm trying to make a point. So hold on, don't throw out the baby with the bathwater. So what can municipalities do? What can governments do to be able to retain their responsibility? Because the responsibility, so let me take that position now, the responsibility of government is to see to it that certain services are delivered to their communities. They can outsource the actual service delivery, but the responsibility they cannot outsource. So what to do? So I wanted to suggest that maybe for the larger projects, for the mega projects in any specific utility, is that utilities through their long-term planning consider contracting the private sector in through PPPs. And that means, and PPPs in all countries, we've got only 10 countries in Africa not having PPP policies or acts. And in all those countries, the procurement through PPP procurement mechanisms are regulated. So the suggestion is to include formally the private sector in the service delivery that need to be done. And the way to do it is to include consideration of making use of PPPs in the long-term integrated capital planning process. So let's break it down. On the slide, you will see in the picture, in any government entity, water utility, we will have an integrated development plan, probably 10 years old, or 10 years into the planning for 10 years into the future, 5 to 10 years. That is supported by a long-term financial plan. And included in that financial plan is the assumption that it is backed up with the asset management plan, that engineering planning. Okay. So the thinking is whilst a municipality, a water utility are doing that long-term planning, is that certain of the projects that need to be procured in the next few years may need to be procured on a PPP basis. PPPs is just a procurement alternative. That is it. It's an alternative procurement model in the big world out there. So the thinking is, during that setting up your long-term planning, your financial plan, one will very quickly realize that in year 5 from today, we will not have sufficient capital in our water utility to actually use internal funds to deliver that project. So even internal generated funds plus borrowed funds may not be sufficient to deliver the project. We can see that today for 5 years into the future. That's not too difficult. Obviously, you need proper data. I think I'll refer to that as part of what credit rating agencies look at. So in this process, you will build up a picture, you will build up a pipeline of projects into the future, that certain of them will be procured using traditional procurement methodologies, and certain of them may be procured using PPP procurement methodologies. So that is part of the solution, because in a PPP, so those projects you procure, so let's say we procure an asset management, a wastewater treatment plant. And maybe we have got an existing plant and the plant needs to be upgraded because there's more people living in our city now. It needs a major upgrade. And let's say we procure that through a PPP mechanism. Remember, when we procure through a PPP mechanism, it's not privatization, because the legal ownership of that waste treatment plant never transfers to the private sector. The private sector only get economic rights that they must manage for the duration of the PPP contract. So it's not privatization. Okay, so we've done that long-term planning now. We have got to look very well at our existing maintenance of our existing assets in our municipality. So the areas in green on the left-hand side, you will see that I've listed AM, that refers to asset management, just to show how important asset management is in this whole process. So we have found many problems right across the continent, and even now doing consulting work for the World Bank, for the European Investment Bank, for USAID. We also did some work for USAID Wash Fund. In many cases, one finds that there's a disconnect between the engineering fraternity and the financial fraternity in one institution. They don't speak to each other many times. In South Africa now, there are many, we've got 278 municipalities. Only 20 of them are able to raise long-term finance. Less than 10% of them raise long-term finance. And yet, we will see that the engineering fraternity do not want to accept the notion that there's no money. And then when there's no money, they actually just leave the asset to deteriorate further. The finance guys is totally demotivated, and that municipality just goes backwards. And we had a very good example, or maybe a very bad example, in South Africa over the last 10 or what years. So I've got to move on. So there's some more information on the slide. We are in essence talking about good governance and good tariffs, cost reflective tariffs. And I think both Anne and Ayel indirectly referred to those. So in this slide, I'm referring to some work that has been done previously by the Urban Water Group, and it's been CIVI, the Stockholm International Water Institute, did some studies, and they found that the fastest pathway to long-term sustainability, to long-term creditworthiness, if you wish, is to start governing better now. So good governance and financial governance, is key to unlocking the water utility sector's potential to become a sustainable and modern service industry. The water sector, you can move to the next slide. The water sector is in essence one of the last sectors in the world that is modernizing. Somehow the engineering fraternity, and I know I'm going to get negative inputs on this, the engineering fraternity has kept the sector back because they are very conservative and want to do things like it's been done yesterday. So as a banker, when we looked at long-term loan applications, we looked firstly not at the ratios, we looked at the recent track record of maintenance of assets. And if the utility does not maintain their current assets properly, you cannot grant them any new money. The ratios can look how good they want to look. But if they don't maintain the current assets, how can they create new assets? That will also just deteriorate. So, evaluating long-term finance applications, one would look at the service delivery record, you would look at tariff setting, you will look at the regular increases. It's absolutely important to increase on a regular basis. You can't skip a year because of political reasons. And we look at tariff collection ratios. Municipalities, water utilities operate in a non-profit scenario, meaning they've got, when they plan their budgets, they budget for $10 income and $10 expenditure. So if they receive anything less than 100% from the bills that they have issued, that municipality can't operate. It's got to cut corners somewhere. Enough about that. So execution of long-term plans, very important for those to be regularly reviewed and then to be implemented. Again, asset management. If they are not implemented, nobody can put any value to that. And as bankers, you cannot put your money behind an organization that do not do what they plan for. The debt portfolio, one will look at on and off balance sheet exposures. So you would look at balance sheet loans, the traditional loans, and you would look at, do they have PPP exposures that may be off balance sheet? And how well do they manage that? And what is the average or the weighted average cost of capital of this municipality? And what is the planned weighted average cost of capital going forward? Now, the only thing I wanted to say in this presentation about weighted average cost of capital is when a utility present information to you as a banker, you want to see that they plan forward, even as far as the interest rates of their loan portfolio. And if that interest rate weighted average cost of capital is too high, one would want to see what is their plans to minimize that. Enough about that. If this municipality is already involved in PPP transactions, one would evaluate their contract management ability. In South Africa, we've been fortunate to retrain one of the municipality's contract management teams. It's a water transaction, now 22 years old, and they've totally neglected the contract management. After we have trained that team, and that was a USAID WASHFUN project at the end of the day, we realized that the private sector actually owed the municipality a few $100 million, and that they did agree to pay. But it's because of the inability of the contract management team to actually do it properly. So if they do that badly, you can't give them any long-term loans. Then the last point of my presentation, if there are backlog maintenance, and in most municipalities or utilities, we do have backlog maintenance. If there's no plan, it's another no for any approach to a banker for a long-term loan facility. So to summarize, what is it that we recommend? Because of the potential, the real and potential disintermediation of municipal services, we suggest that local governments and utilities consider to formally appoint private sector service providers under a regulated process, and that means through a PPP procurement, because then at least they've got full control of the service delivery, of the performance of the private sector over the life of the project. And then on top of that, to have specific plans to improve their backlog maintenance, because engineers will tell us that if we do not maintain well today, that for every year that we do not maintain well, we put ourselves 2, 3, 4, 5 years back, and we are not able to catch up even in a 5-year period. So can we then, as bankers, I've asked you to be bankers for a while, give a municipality that does not maintain its assets properly, can we grant them additional loans? Probably no. Thank you, colleagues. Appreciate the time. Thank you, Marika. Yeah, we can, maybe I'll just summarize quickly. This is just a slide indicating the financial planning at the top of the graph, of the picture, and engineering asset management planning at the bottom. And at the left-hand side, there's a little procurement block. And that is where the procurement decisions need to be made. Are we going to procure through a traditional mechanism, or are we going to procure through a PPP mechanism? Countries that do this very well at this moment, the counties in Kenya is doing it very well. Rwanda is doing it very well. Uganda is coming to the party. They are developing some waste treatment plants, generating electricity from waste. And on the left-hand side, you will see there's some further suggestions for you to consider. Thank you, Marika.
Thank you, Andre. We do have 2 questions. So one says, if we look at PPP in the water sector, we are talking about assets that last 20+ years and also need this degree of long-term finance. Sure. 1, does the municipal legislation allow for these timeframes by now? And 2, can a bank agree to a fixed interest term for such a long time frame, or will there be special clauses to allow changes in the interest rate?
That's a very good question. Thank you for that. So firstly, theoretically, water utilities, municipalities, can enter into contracts 20, 30 years. The one PPP that I've been referring to here in South Africa is a 30-year contract. So firstly, theoretically, they can. It's also one of the important factors that you create PPPs or structure PPPs based on the life cycle of the assets. So a motor vehicle outsourcing contract, PPP contract, is only 5 years, because vehicles optimally live only for 5 years, optimally. So then the second part of the question was about interest rates, and will banks provide that long-term finance? And the short answer is yes. So banks will provide, commercial banks, I won't talk about on behalf of DFIs, even although I could. Commercial banks will offer that longer-term rates, fixed rates even, for longer-term periods, because of the lower perceived risk in PPP's transactions. So in South Africa, in Kenya, or maybe let's stick with South Africa that I know much better. So for a balance sheet loan of a major municipality, bankers will provide a 15-year loan. And that same municipality entering into a PPP transaction will probably, the private sector that raised the finance will probably get a 20-year loan. Because there's performance, the private sector is operating under performance risk. And that is why you can do it for a longer period of time. And it's not an Andre Kruger company that delivers the services. It's a proper water operator that actually deliver the services. So there's lesser risk, long-term risk for financiers. That you are welcome to contact me. You can check out our website, PPP Training Online. My email address will be on there, or even on LinkedIn, and I'll gladly, either through Rockblue or however you want to contact me, to answer these in more detail. Thank you, Marika.
Okay, great, thank you. So one last question. What is acceptable collection rate, bearing in mind that some are willing to pay it, do not have the means to pay it?
Yeah, okay, that's a good question, and maybe I triggered that through my comments. And my comment was just to take it back to that. So a municipality, a water utility, is not a profit-making institution. So it typically budget $10. I'm just using 10 as a proxy. They budget $10 to be able to cover all their expenses. So if they do not collect the $10, that water utility cannot operate properly. So what is the optimal collection ratio? It's 100%. If a municipality know upfront that it's not going to collect 100% because of indigent people that cannot pay, they've got to budget less. They've got to pay less salaries, because salary is the biggest component in a water utility. And that's a hard truth. It's not a sometimes our water utilities need to pay less salaries to actually make services affordable. I'm a little bit harsh there, but just to make the point. So in South Africa, when you're sitting in a bank, and we've got 8 metropolitan governments in South Africa, the really large metros, if they collect below 99%, their interest rates will go up if they borrow from you as a bank. For smaller municipalities, if they collect below, under correction, I think 97%, they will have the same effect. The interest rates will be higher because it's a higher risk. So if a municipality only collect 90%, how can you finance them? Because they don't receive, they are out of pocket 10 for $1 already. Anyhow, I hope that gives a high level answer.
Yes, it does. Thank you so much. For attendees, if there's any questions that you have, we have some more time, so we're going to go back to some of these other questions. Just put them in the Q&A. One last question for you, Andre. What would you say are the most critical ways that a development partner like USAID can support utilities become more financially sustainable and attract other sources of financing?
So please take it from me. I worked in the private sector my whole life, so I'm coming from a private sector, and saw significant inefficiencies in governments, in local governments, in water utilities. So much so that the users are actually paying more for water than they should because of the inefficiencies in government utilities. So please take it from me from that perspective. So what can they do? The moment you enter into a feasibility process, in this World Bank course that we train, the course that we train is a World Bank developed course, and it's being, we train people from across the continent. What you do during the feasibility is to test value for money, meaning that over the life of the project, government need to try and minimize the life cycle costs. So what we see in PPPs, and we've got about 50 PPPs in Africa, water PPPs in Africa, 50, most of them offer mass transactions in Western Africa. So what you see in that value for money calculation is that in most cases, the private sector is able to deliver that same services that governments deliver or utilities deliver, make a profit, and still do it at a lesser cost than what government is doing it currently. So what is the trick? Do a proper feasibility study. The regulations in all African countries, if I just stick with Africa for the moment, but the same applies outside, follows a proper due diligence process. And if it is different, if the utility is actually delivering services at a lower rate than what what private sector can deliver it at, then typically they must do it themselves and not procure a PPP. But it's a litmus test, literally, to see if the private sector can do it better or less for lesser cost and make a profit.
Okay, great. Thank you. One more question for you, Andre. The free water policy in South Africa was set up to provide free service for fixed quantities that could not pay. Yeah. Thus, there is a subsidy from customers that can pay. Why haven't other countries like Kenya developed such an approach instead of experiencing poor collection ratios?
So why has Kenya not done it?
Or other countries, yes.
Yeah. So maybe just to say, I think the system is working fairly well in South Africa. The challenge that we have is to monitor people that are really indigent. So if you are working in a municipality and on a regular basis, maybe it cannot be annually because there's just too many people that's indigent also in this country. So let's say on a two-year basis, you need to check, are these people really indigent or are they taking a chance? But over and above that, the system is working fairly well. In this 22-year-old PPP that we have in South Africa, one of the water PPPs, we've got 5 water PPPs in SA. In this specific one that I'm referring to, the private sector operator that operates the PPP actually receive a portion of the of that subsidy from the municipality to cater for the people in its own jurisdiction. Why others haven't done it, I unfortunately can't go there. Thank you.
Another question. Who conducts the value for money assessment? An independent consultant hired by the government?
That again is a brilliant question. So I'm tempted, and Rockblue will say I'm doing an advert here. You can do this course. There's about 30 accredited training organizations worldwide that offer this certified PPP professional courses. So if you're interested in that, you can Google that, and you don't need to do it through my company. You can do it through any one of the others. There's, I think, 4 in Africa that train in Africa on the same. So who does it? The regulations in every country will determine that government need to create. Can I use Botswana? There's a very nice water transaction currently. We know that Botswana, specifically Gaborone, is running out of water. I think in a year or 2, they're not going to have sufficient water in Gaborone for potable purposes. So they are developing a wastewater reuse plant for potable purposes, and it's a PPP. So what happens is within Water Utilities Corporation Botswana, that's the water utility responsible for water, they've created a project team with a very strong project manager. They then hire a team of transaction advisors based on the regulations in their country. It's a regulated process as well. So there's somebody from their National Treasury, from the Department of Finance, that look from the side and see that they do every step correctly. So the transaction advisory team will literally develop the feasibility study, but the project team within WOOC, they take anything that's recommended by the transaction advisor to the board of WOOC. WOOC is Water Utilities Corporation. So yes, you make use of transaction advisors, but then they don't make your decisions. Government still make the decisions. So we were fortunate, we were hired by the IFC to train that project team because the IFC wanted a stronger counterparty, and we were able to train that team through 3 courses. Yeah, let me just stop there. Yeah, thank you.
Okay, thank you. Okay, we have a question for you, Anne. So it's asking if it would be great to get more specific example of when you use this creditworthiness framework to support a utility in Kenya, and if the utility was able to access better financing terms. And if not, what were the key challenges beyond strengthening creditworthiness to mobilizing commercial finance from your perspective and based on your experience?
Thanks, Barika. That's a really good question. And I think what we've found in our experience is that water is considered a risky sector, especially due to sort of like the governance issues, the fact that it's considered a public good and whatnot. So some commercial investors, for example, local banks, will typically shy away from extending financing to water utilities. And that's why starting to build a credit history is really important. So even if water utility is able to access financing, maybe using a credit enhancement mechanism, maybe it's like output-based aid. So they get some financing from the local bank backed by either a guarantee or output-based aid from our development partner. Then once the utility is able to prove that they can be able to repay back, we've seen that even time and time again, when this water utility goes back to that particular bank, then they're able to get more financing even without the credit enhancement mechanism, whether it's a guarantee or an output-based aid, just because they've been able to build that credit history and sort of starting to demystify the fact that it is a risky sector and commercial banks can actually extend financing. And to your point of a specific example, unfortunately, I can't be able to divulge the name of the water utilities that should be able to extend financing just because of confidentiality. But back to the point on the presentation is using it as an internal resource to really see like areas you can be able to increase credit worthiness. So that was that first screen of, okay, what's your profit margins looking like? What are sort of like your debtor days looking like? What sort of some of those other considerations, and what can the water utility start doing to be able to address that before even getting external financing, so that by the time it's getting to a point where you're approaching a financial, you've already sort of internally started putting in some of those measures to be able to strengthen your credit worthiness before even getting to that financial. So yes, there were some utilities that were able to get financing, but it was more so because internally they were able to put in some of those measures and present a much stronger business case to the commercial bank to put them at a better place to be able to negotiate some of those terms.
Okay. Thank you. Can you tell us kind of what size the water utilities were?
So if you think of sort of like the largest water utilities in Kenya, so mid to large water utilities, it sort of put them around that range.
Okay, all right, thank you. For Eyal, we have a few questions for you. So when you assess credit worthiness, would you consider a ring-fenced project, assuming that the revenue ring fencing can be digitally enforced, as having its own credit worthiness, which might be different from the main utility as a whole?
Okay, yeah, I mean, we could certainly take a project-based approach to rating a project. I mean, that would obviously be more like a project finance approach. And in that case, then we would look at the specific costs of the project, the difficulties in implementation and the challenges that could happen during the implementation phase, and then the offtake agreements that underpin the future inflows. And assuming that those are all in place, and I mean, normally there would be guarantees, or the offtake would be a national government, it could be quite a highly rated project, and therefore money could be raised on the back of that project alone, not the whole water utility. The alternative would be, there is that it's not fully ring fenced, but there may be some secured cash flows or something like that, or secured assets, where we would look at the credit quality of the water utility, but then say a certain issuance from that credit could be of a higher credit quality because some sort of security, like I said, whether through assets, whether through future cash flows, is being offered to the investors in those particular notes, and therefore it would get some uplift, or guarantees from which is pretty common, from like an international guarantor agency like Garanco, or some of the insurance companies offer such things, or development agencies. So there's various ways you could credit enhance a project or an issuance itself.
Okay, thank you. We have one more question, and let's see, this is to all the speakers. Isn't the starting point the core point of the problem that we have lots of utilities, and in South Africa, municipalities, that do not have capital costs, whether it is depreciation, interest, loan repayment, or investment, sufficiently covered in the tariffs? This is what Andre was talking about. The consequence that I see every day is that this in turn results in bleeding the assets, inadequate maintenance, poor operations, needless bureaucracy, poor leadership, and NRW, et cetera. The reason that tariffs do not cover capital is that it would result in tariffs that are too high for large portions of the population. So in the end, it all boils down to generic economic conditions, ability to pay for water. What are your thoughts?
Yeah, that's a really good question. And I think it's a challenge we continue facing in this wash sector specifically. In the formulation of those tariffs, for example, if I look at Kenya, there needs to be like community participation in making sure that the tariffs are sort of conducive, or as you're saying, like looking at the economic conditions of the population being able to pay. And particularly what we've seen, for example, in water utilities that are serving both urban and rural areas, is that you'll typically say that urban areas probably have some sort of like, in terms of the economic ability, they're able to absorb higher tariffs compared to rural areas, for example. So we've seen these water utilities having a think and having a look at, is there a way that they can sort of start looking at sort of like that differentiation in tariffs? Typically it's not too huge, but is there a way they can start looking at that differentiation in tariffs, such that for the urban population, they're able to increase their collection efficiency, they're able to maybe charge a slightly higher tariff compared to the rural areas, for example. So definitely that's a problem that continues becoming sort of a quagmire, and something that water utilities keep facing, keep evaluating. I know, for example, the regulator in Kenya, WASREB, looks at a tariff that's inclusive. So apart from 1M cost, what are sort of some of those investment or capital costs that you're looking at, just to make sure that that tariff is comprehensive, and obviously dependent on that community participation, to make sure that the tariff is not too high or too much of a burden for the population.
I can see that being a problem in many areas. Thank you, Anne. Okay, here's one more question. What happens when credit ratings are not approved or accepted by municipalities? That might be something.
Yeah. So I think Al maybe could provide better context based on like the credit ratings. But for Kenya, for example, and maybe other sub-Saharan African countries, probably have sort of some of those credit indexes that have been developed by some of the regulators or some of the ecosystem players. And this is probably done by the regulator, and also in consultation, for example, with their respective utilities. So that just helps in terms of getting buy-in. If this annual report that's sort of churning out the performance of different water utilities, then the water utilities as a whole are able to see this, and that also helps to generate buy-in.
Okay, great. Hi, y'all. Welcome back.
Thanks.
I don't remember what question you were answering, but we do have one that Anne was just answering, but one question says, what happens when credit ratings are not approved or accepted by municipalities?
So, I mean, generally, the first time we do a credit rating as an agency, the client or the issuer will always have the opportunity to publish. It will be at their discretion whether it actually gets published or not. So, you know, they can't, I mean, they're welcome to challenge the outcome and appeal it if they're unhappy. But once a rating, the credit committee has made its decision, the decision after an appeal, the decision will be final. But it doesn't necessarily have to be published if that's the case. And in fact, a lot of the work we've done in the past is that a utility will do 1 or 2 years of ratings on a private basis for exactly this reason, to get everything running smoothly, to understand the process, to make sure it's coming out at a meaningful level, that there's been some improvement before choosing to actually go public with the rating in a subsequent process. So I mean, that is actually perhaps the preferred method. I mean, when we do ratings on an entity that's not used to that type of process, or, you know, or that, yeah.
And how long does that process take for a new entity, you know, a municipality
So, I
who's
mean,
never done it?
for a new entity we've never looked at before, I mean, it would probably take about 8 weeks from start to finish the process. That's collecting the information that we need, which is our financial statement, strategy documents, various legislation, you know, those type of things, performance metrics, we'd generally spend a day or two, then travel out to where that utility is, spend a day or two with the management team to go through, hear the story from their own words, go through the financials. We would have had a chance to have looked at it, go through the financials, ask questions, see the operations in practice. It's always good to put a visual to numbers, to see how it's working, what they're dealing with in reality, and then come back and then compile the rating report and the rating and the packs for the credit committee, and then come out with the rating, and then present it. And then after we would, certainly for first time rating, we would present it to the management team, the outcome, why we came up with each factor, how it played, what the strengths, what the weaknesses are, and then after that, if everybody's happy with the rating, then we would and wants to publish, and we would publish it. If the team decides, it's been a useful exercise, but we'd perhaps prefer to keep it private for the time being and improve on the areas that need improvement, and then publish, and then that's what will happen. And then the next year we'll do the same, go through the same process basically, and see those improvements and the progression, and do a report based on that.
Okay, well, thank you so much. That's all the time we have. I want to thank our presenters very much for giving their time and their expertise to this great topic. I want to thank all of our attendees for your participation as well. The session will be uploaded into the Brock Blue website in about a few weeks, along with the questions that were not answered live. And please stay tuned for our next OLS that will be happening next month.